In this video, we will show you 3 profitable trading strategies using the Fibonacci tools. We will also reveal our #1 entry technique for these strategies. Each entry technique will enable you to make strong entries with tighter stop losses and larger targets. Many traders use the Fibonacci tools, but most use them incorrectly. The most confusing part about the Fibonacci analysis is deciding the swing points to draw the Fibonacci levels. We will reveal our secret hack to remove all the guesswork and provide a mechanical framework to draw these levels. Here are the topics covered in this video. First, let's begin by understanding the Fibonacci sequence. What is Fibonacci? Fibonacci is a number series that was discovered by an Italian mathematician. Each number on the series is calculated by adding the last 2 numbers. So 1 plus 2 is 3, 2 plus 3 is 5, and so on. The fascinating thing here is that if you multiply any number on the series by 0.618, you will get the prior number. Therefore, 0.618 is known as the golden ratio. So, some traders thought of applying this to trading, and the results were astounding. They discovered that the Fibonacci ratios could be used to identify the start and end of a price move. Over the years, traders have developed 3 techniques to achieve this. Number 1, Fibonacci retracements. Number 2, Fibonacci extensions. Number 3, Fibonacci projections. Each of these techniques can be explored in much detail. For the purpose of this video, we will focus on the most popular technique, which is the Fibonacci retracements. If you want us to cover the Fibonacci expansions and projections, comment below. Let's now understand the Fibonacci retracements. During a trending market, the price generally moves in a zigzag pattern. We have strong moves in the direction of the trend, followed by pullbacks. These strong moves in the trend's direction are also called impulsive moves. An ideal entry can be made at the end of a pullback and the start of an impulsive move. The Fibonacci retracement tool helps us to identify these entries. Whenever we see a solid trending move, we need to plot the Fibonacci retracement tool from the start to the end. This gives us 3 levels where we expect the price to pull back. A lot of traders use different Fibonacci levels for their trading. But, through our experience, we have discovered that most pullbacks fall at 3 key levels. Once the price arrives around these levels, we can expect the price to reverse and move upwards. Similarly, in a downtrend, when we spot an impulsive down move, we can draw the Fibonacci tool from the start of the move to the end. We get these 3 lines where we expect the price to pull back and move downwards again. These 3 levels collectively are called Fibonacci retracement. Let's now explore the meaning behind each of these levels. Deep versus shallow pullbacks. Whenever the price pulls back to the 38.2 retracement level, it shows that the trend is strong. Every pullback is thought of as an opportunity. There is a level of excitement among traders to enter and capture a piece of the trend. Such strong trends are very rare, and most of the time, the price will pull back to the other 2 levels. So avoiding the 38.2 level is a good idea. The area between 50 and 61.8 level is known as the golden zone. Typically, the price will pull back to this area before reversing. A pullback to these levels indicates that the trend is mature and experiencing deeper pullbacks in price. However, a mature trend does not necessarily indicate weakness. In fact, such trends can last for a long time before reversing. At trade prime, we only trade the pullbacks to these golden zones. Throughout the rest of the video, we've exclusively used the golden zone for our trades and strategies. Please remember this going forward. As mentioned earlier, many traders need help with determining the swing points to use when drawing Fibonacci levels. Let's now solve this problem. The secret hack. To solve the problem, we will use a simple indicator called fractals. Fractals is an indicator that helps us identify reversal points. The indicator plots arrows at the reversal points. Fractals are of two types, up fractals and down fractals. An up fractal is created when the high of a particular candle is higher than the previous two and the next two candles. It shows a bearish price reversal. On the other hand, a down fractal is created when the low of a particular candle is lower than the previous two and the next two candles. This shows a bullish price reversal. To plot this indicator, go over to TradingView and click on the Indicators button. Then type in fractals. Click on this indicator and your chart should look like this. If we keep the settings to default, the indicator will plot every minor reversal. That will end up confusing you more than solving the problem. So we will change the settings to 5 period. Now, the indicator will mark only the strong reversal points. However, sometimes the indicator will also mark irrelevant swing points. Therefore, you can use this indicator as a beginner, but your long-term goal should always be to develop experience in identifying major swing points without the indicator. All we need to do now is look for a trending market and draw the Fibonacci retracement tool on an impulsive move. Here is an example. Here we see that price was in an uptrend, making higher highs and higher lows. Then, we spot this impulsive up move. The move starts from this down fractal and ends up at this up fractal. So, we draw the Fibonacci retracement from the start to the end. As you can see, the price then pulls back to the golden zone and reverses upwards. Here is an example of a downtrend. We see the price making lower highs and lower lows. So we consider the price to be in a downtrend. Then, we spot this massive down move and draw the Fibonacci retracement from the start to the end. As you can see, the price pulls back to the golden zone and moves lower. So this is what we want to trade. We want to enter on these pullbacks as early as possible using the Fibonacci. But we will not rely on Fibonacci alone. We will look for other confluences to identify high probability trade setups. Now that we have covered the basics of Fibonacci, it's time to move on to the advanced strategies. But before we do, be sure to hit the like button and subscribe to our channel so that you never miss our new videos. Whenever we upload new videos, we always get asked about a specific time frame that a trader should use. We at Trade Prime use the 4-hour time frame for our trades. The examples shown in this video are also based on the 4-hour time frame. Strategy number 1. Swap zone confluence. Swap zones are one of our favorite techniques to add confluence to any strategy. Swap zones are nothing but levels of support and resistance. When the price breaks below a support level, it becomes a resistance level. Similarly, when the price breaks above a resistance level, it becomes a support level. Since the support and resistance swap with each other, we call them swap zones. We will use this concept in combination with Fibonacci retracement to identify trade opportunities. Here is an example. The price was in an uptrend, making higher highs and higher lows. Here, the price makes a high and pulls back. We identify this as a resistance level and mark it. Then, the price breaks above